Visions are desires that flicker between a wish and intent. They are carvings waiting for the artisan's hand. One who is consumed by purpose. One who can bring vision to fruition. Cliff Decker Hofmeyer, incorporating Kieti law from vision to fruition.
Hello, boys! I'm back!
There you are, ladies and gentlemen. Thank you so much. Are we back? Very much so. Thank you for all that's attending in person. We really appreciate that. It's really your guinea pigs in the sense that we're trying out a personal, we're going back to normality as such. Thank you for that. And then the few hundred that's actually attending via Teams, we also appreciate that. There's a number of events right now, and you could choose them. 4, 5, and we really appreciate you choosing us and be with us. We're trying to make it as informative as possible and to cater for your needs and those type of issues that are relevant to yourselves. So some of the things may not be that relevant and others are more relevant, but we really appreciate that. It's really 3 speakers. We're going to start with Annabelle Bishop. She's the Chief Economist of Investec, just giving an overview of the economy and what's happening. Then Gerard will continue on the VAT side, and then lastly I'll make up the rear with reference some corporate taxes and whatever incentives you are. I hope you've got your 15,000 Rand available that you're going to invest immediately or not immediately, because otherwise you might not get the allowance. So from that perspective, thank you so much. We really appreciate that. And yes, we're back, and hopefully next year it's going to be just an in-person as opposed to just a Teams event. But yes, let's see. Thank you, and thank you for all that's attending. Afterwards, there will be something to eat outside from that perspective. Thank you.
Hi, okay, I've been asked to start via the chat. Sorry, I thought they would have introduced me. Apologies for that. So I did want to say that we have had a very good budget given the set of circumstances that South Africa is operating in. And of course, you know, that's very pleasing. The markets were expecting a worse outcome. The reason why I say it's a good budget is we both saw some debt relief on the side of Eskom. And of course, that's about 75% of the 350 billion which government guarantees of Eskom's debt. This obviously has been something that's long awaited, and of course it does place us in a position now where our government debt does increase. And the key ratio perhaps for you to note this evening is that gross debt of government is now projected to stabilize at 73.6% of GDP, and that is in 2025-26. Previously, the projection was estimated to peak at 71.1% in sorry, there's some feedback there, to peak at 71.1% this year. And that, of course, was in last year's October MTPBS. But that doesn't include the Eskom debt that government's now taken onto its balance sheet. The good news is that this is credit neutral. The credit rating agencies already rate South Africa's government debt as including all the debt of the state-owned entities that it guarantees. So it includes the entire 350 billion of Eskom's debt. That there is a contingent liability on government's balance sheet, and of course other areas where it also has guarantees over other SOE's debt. Government is actually trying to work down the debt it guarantees for state-owned entities. It wants them to become self-sufficient, and indeed it's even reassessing them to make sure that they are necessary, and that is good news for South Africa because it does reduce the pressure on government finances. The budget overall we think is credit neutral to even slightly positive. We don't think the credit rating agencies will really make any changes to their rating views of South Africa. S&P rates us in May, and Fitch and Moody's may rate us around that time, if not before, but they haven't released their calendars yet. We do see that the government finances experience some improvement. We actually reach a primary surplus in the current fiscal year. A primary surplus is something good to have. It means that your revenue is actually exceeding your expenditure. If you exclude your non-interest debt. Of course, we also find ourselves in a situation where our government deficit itself, that's just your plain revenue and expenditure, and that's obviously something looked at as well by the credit rating agencies. That has actually dropped to 4.2% of GDP from 4.9% projected at the medium-term budget policy statement last year. And in fact, we do find ourselves also continuing to see the downward trajectory of this metric, reaching 3.2% in 3 years' time. And what that really means is that government is consolidating its finances. I also read in the budget review itself today that we are also seeing debt falling at a faster pace. I think overall, though, I really would give the budget about a 7.5 out of 10. The reason for that is we're operating against a very difficult economic environment. We have an electricity crisis, and of course, as well, we also have a situation where we still have an unemployment crisis. We are seeing a building crisis in our transport, our logistics of rail and port, and of course that will impact government finances in the future. And we also have seen floods and water shortages plague our country as well. I think it's quite key to note, however, that I want to read you something that Fitch wrote just before the budget. They said that the latest forecasts indicate that the government's deficit would stand at 5.1% in the current fiscal year, and recall now it's 4.2%, and stay close to that level in the following 2 years. And of course, as we note, it actually drops down below 4% to 3.2% ultimately. So the fiscal deficit, which is one of the metrics that the credit rating agencies rank, is coming out better. The government debt, as we said, coming out worse, the ratios, but that's because of the Eskom inclusion for the debt relief. So really, we find ourselves in a situation now where we are actually experiencing a better than expected outcome for today's budget, but going forwards, much will depend on the health of the economy. And that's why we can't give the budget a better rating than 7.5 out of 10, because we worry, and even that's quite a high rating, because we worry about the damage to the economic outlook that really comes through as a consequence of the real difficulty that South Africa faces in the number of crises, which I touched on. Fitch itself said that low potential economic growth at 1.2% remains a key credit weakness for South Africa, and a further weakening of the trend growth or a shock that further undermines government's fiscal consolidation efforts could result in a negative rating action. So we are at risk of a credit rating downgrade still, not necessarily an upgrade. The rating agency did give us some leeway, and they said there is some headroom at the sovereign rating. Of course, we're at BB- to absorb a temporary impact on economic metrics from load shedding, but a failure to address the problem over the medium term could add to downward pressure on the ratings. So that's where we sit from the rating agencies. I think turning instead to have a look at the budget itself, we saw some quite substantial tax relief of 13 billion. The government noting at the same time the social wage is protected and the balance is restored without resorting to unsustainable borrowing and damaging tax increases. The social wage obviously being the public healthcare system, public education, safety and security, a number of the expenditures that government provides in South Africa, including, of course, social welfare. The revenue overrun, so government collected more revenue than anticipated, does get split into reducing debt. Even though the debt went up overall, there was some reductions in that, and of course as well allowing the primary surplus we mentioned. The 2023 budget tax proposals therefore do not increase the overall tax burden, and instead the tax take, as we said, falls by 13 billion. 4 billion of this drop is budgeted for incentives for individuals utilizing solar aimed at relieving the energy crisis. So in other words, individuals will obtain a tax rebate amounting to about a quarter of the cost when purchasing new or used solar panels. They of course must be purchased and installed at a private residence because it's for individuals. And this incentive can be used for next fiscal year and is obviously capped at 15,000 per person. So I just think that this is one of the factors that government is looking at, both to help in terms of the energy crisis. The cost of living crisis that we've obviously seen as well has been supported by the fuel levy not being adjusted. It does provide some relief to soaring living expenses, but of course the cost of living, or the CPI inflation rate, is still well above the target at 7.2% versus a target of 4.5%. So inflation adjustments do occur for personal income tax and retirement tax, as well as transfer duties and excise duties for alcohol and tobacco, the sin taxes as usual. Another piece of good news, though, is that the diesel refund system, which provides full or partial relief for the general fuel and RAF levies to the primary sector of the economy, which is your farming sector and your mining sector, will be extended to the manufacturers of foodstuffs. So that's to obviously try and provide some help to limit the impact of power cuts on food prices in South Africa. Turning away from inflation and back towards the incentives government has for renewable energy in South Africa, they've got a further 5 billion incentive, which has been announced today for the expansion of Section 12B for businesses. The current incentive, as you probably know, some of the people in the audience, allowed corporates to subtract the costs of qualifying investments over a 1 to 3 year period, which creates a cash flow benefit in the early years of the project. Businesses thereby are permitted to subtract a 50% cost in 1 year and then spread out 30-20 in the respective following years. And this, of course, is for green, clean energy, qualifying investments in wind, concentrated solar, hydropower below 30 megawatts, biomass, photovoltaic projects above 1 megawatt, investors in projects in general, obviously benefiting there from it, but I think the tax incentive, which has been expanded on a temporary basis to attract swift investment in renewable energy to take pressure off the grid, we might find these types of incentives become more permanent as countries around the world continue to fight against climate change and the negative impacts that obviously it has on economies, lives, and livelihoods. Turning away now from these topics and having a look at economic growth, the credit rating agency Fitch already noted the concerns it has about South Africa's weak economy, and of course as well it also talks about the worries that it has around the national state of disaster South Africa has had to go into, because obviously, of course, as a result of the electric crisis that we experience. I think, in general, however, the budget has done as much as it possibly can in a bad environment. If we're in a much better economic environment, not only would we perhaps have a bit more confidence in terms of its government projections, it's not that we don't, we just see there are multiple risks to them, but also, of course, as well, government could have projected even better fiscal outcomes and reached fiscal consolidation earlier. Having a look at the revenue front, from a government revenue perspective, we did see better collection than expected, as I mentioned, and the tax revenue collections for 2022-23 are expected to exceed the estimate made a year ago by close to 100 billion, and the mining sector, of course, accounts for nearly 30% of this. Over the next few years, we do expect to see, from a fiscal consolidation perspective, that government spending will only rise by about 4.5%. That's actually quite key, because what it really means is that we find ourselves in a space where we don't see real increases. So from an inflation perspective, we don't see the government expenditure increasing by more than inflation, so it actually is a 0% increase. So again, that's quite positive from a fiscal consolidation point of view. The other areas, I think, perhaps we can address in questions if there are any, but really, in summary, because I've been asked to speak for about 15 minutes, in summary, we have had a good budget. I think, much is going to depend now on the rollout going forward of the plans government has to implement for the electricity crisis, and it's quite important to note that we really just have the budget as a document, as a speech, as really a budget review that outlines where government allocates money to be spent and where it collects revenue from, the health of government finances, and of course what it can do to assist from a financial perspective. It's not really a document which is going to lay out new policies or give us greater insight perhaps into areas such as public-private partnerships, but there obviously are many other departments as well in South Africa that obviously tend to do so. From an economic perspective, the budget did see a downward revision to economic growth. It dropped from 1.4% for this year to 0.9%. We think that's a very sensible outcome. If we have a look at the Bloomberg and Reuters consensus that was published last week for the economy, we really saw that we experienced a outcome of around 1.1, 1.2%. Now that was blown up by a couple of large forecasts of above 2%, which are unlikely for economic growth for this year. If we take them out, we actually get a figure surprisingly of 0.9%. So we think that the economic growth forecast by National Treasury is actually very sensible. We support it, and we think it's very aligned to expectations through the economy. We have 0.7%. We anticipate a little bit more load shedding, which has obviously come through. I think it's difficult, though, to make economic forecasts, particularly at the start of the year. And of course, no one can make them with any guarantee of 100% accuracy. So from that perspective, government has actually done very well. It doesn't put itself in a situation where, for example, it collapses at the economic growth forecast like National Treasury did, which would have shot up the government ratio substantially higher. In fact, the actual small increases that we did see in the ratios, which would have come from the lowering of the GDP growth projections. And bear in mind, it didn't lower the GDP growth projection for 2025, and only slightly lowered the one for next year by 0.2%. That hasn't had a very substantial impact on the fiscal ratios at all, and the rating agencies will therefore just focus on the Eskom debt increase mainly, and of course, as we said, that's credit neutral. So looking forwards, we hope that these government finance projections will stick, and we hope that there obviously will be a lift in economic growth. I think that there is going to be some quite significant relief coming through from the Eskom side by increased private sector electricity generation. The Minerals Council has indicated that the mining sector can add 6.5 gigawatts of electricity production so that then would take it off the grid. It would take the pressure off Eskom, and of course as well the growth of renewable energy in South Africa as well as a key space, both for the private sector and for the productive capacity of the economy. Much, of course, will depend on government regulation and government's ability to help and support the private sector forge forwards in terms of improving electricity generation in South Africa and addressing the electricity crisis. And that can be done by reducing any regulatory burdens which are stifling private sector investment. And of course, as well, we also need to not forget transmission in South Africa. So, that is a big issue as well. The transmission of electricity, not just the generation of electricity, although the debt itself, as we were talking about earlier, has been addressed to a significant perspective. I think just really ending off now, Emile, I don't know if we want to start taking questions.
Can you hear me? Yes. Can you hear me?
I can hear you perfectly.
Yes, thank you. We've got 2 questions in the meantime, and by all means, you're free to ask additional questions. I think the first question was, is Eskom not going to pull us down? Maybe to to get your answer on that one first, please.
Yes, it definitely will. Eskom's been pulling us down a lot. And I think, if we look at the South African Reserve Bank's recent change, its economic forecast for GDP growth this year, they've actually dropped it down to 0.3%. You can see that's well below Treasuries and the economic consensus. In fact, even ours at 0.7%. I think they're predicating it on the back of the 2019 experience, when economic growth then was also around that mark. What we see differently between then and now, in other words, the year 2019 and the year that we're currently in, 2023, is that 2019 was still very negatively affected by the trade wars, which I think we might have forgotten about under Trump, and of course as well that did have some suppressing effect. It doesn't mean that our economic growth forecasts are not at risk. They are. And I calculated, when I dropped my economic growth forecast from 1.1% to 0.7% early this month, that we are likely, if we see stage 4 load shedding as an average for this year, to see economic growth come out of that at the 0.7%. There was also some uplift from the better outlook for the global economy than was previously anticipated. However, if we move to perhaps stage 6 as an average for this year, then we might find our economic growth forecast much closer to 0.
Sure. The second question was really, is the inflation rate under control or not? Or do you expect that to increase still?
I think that's a lovely question also as well. Thank you for both of them. The inflation rate obviously rose very sharply and reached 7.8% in July last year. That obviously was a big concern. because it really increased the cost of living dramatically for the poor, for the middle class. Overall, it was a very difficult environment. It was driven by substantially higher food price inflation and, of course, as well, substantially higher fuel price inflation. Now it's dropped back to 6.9%, I stand corrected. The latest figures have just come out, and is likely to drop back to 4.5% in the second half of this year. So that's good news, and obviously things are looking better. But the core inflation measure, and this is true for countries around the world, not just South Africa, consumer price inflation has been dropping quite rapidly, but core inflation measures have not. And that really is a measure of inflation where you remove the food prices and fuel prices, whether it's electricity or energy, from the overall CPI inflation basket. And that really places us in a position then where our core inflation hasn't dropped much. It hasn't dropped much in the United States, it hasn't dropped much in Europe, and of course the same for South Africa. And what this really means is that high interest rates, first of all, are likely to stay for longer, and there's a risk of interest rates even coming out a bit higher. So inflation itself, yes, is falling and would probably come under control in the second half of this year, barring any shocks. But of course, the core measures are much stickier and more difficult to come down. They're much more broad-based.
Any other questions from the floor, perhaps? No, thank you. Thank you, Annabelle. We really appreciate it and appreciate the time that you've made. We know that you're not feeling that well, but we really appreciate it. And good luck for the rest of the evening or your interviews. Thank you.
Thank you so much. Thank you, everyone, for attending. Thank you. Goodbye.
Thank you. That was Annabelle Bishop from Investec, Chief Economist. And then now over to Gerard Baardenhorst from a VAT perspective and to find out whether there's any concerns from that side.
Yeah, good evening, everyone. It's good to see some of you here in person. Haven't seen you for quite some time. So if we turn to the VAT aspects of the budget, I just want to see some of the slides, please. What we've seen is the current revenue prediction of 426 billion rand that they expect to collect by the end of this fiscal year. That compares to 390 billion rand of last year. And we've seen the total VAT collections as a percentage of the VAT collections as a percentage of total tax collections is around about 25%. Now, that remained at that percentage right from the start when VAT was introduced, and even when we had the VAT rate increase from 14% to 15%, there was only a slight increase in the VAT collections. The VAT rate remains at 15%. I don't think that there's any surprises there. As far as the proposals are concerned that are contained in the budget, there are a number of Section 72 decisions that are now being, or that what they will incorporate into the legislation. And the first one is with regard to short-term insurance. There has been certain Section 72 decisions, particularly where you take a damaged vehicle to a panel beater, that the panel beater was entitled to issue 2 tax invoices, one to the insured for the excess and one to the insurer in respect of the balance of the payment for the damages. Now, there were certain issues as far as that transaction is concerned. It seems that they will now introduce that into the legislation to clarify that aspect. As far as prepaid vouchers are concerned, in respect of the telecommunications industry, there has been long-standing disputes and discussions between the industry and SARS in respect of these prepaid vouchers, which the Supreme Court of Appeal recently has ruled that it is a voucher that you need to account for VAT up front on the total sales consideration. But I think SARS has eventually now realized that these vouchers can be used not only for the services provided by the telecommunications company, but also by third parties. And then to account for the VAT up front really creates a difficulty as to when the voucher is redeemed, what about the services that are provided by third parties? And it could even be VAT exempt or non-taxable services that are provided, like money in a wallet, as far as that is concerned. So hopefully that will be clarified now as well. With regard to the temporary letting of residential accommodation that is developed for sale, there has been amendments and concessions over many years with regard to what the VAT implications is when you develop residential property for sale, but you can't get the property sold and you have to let it for economic purposes or whatever the case may be on a temporary basis. Now, we've seen that there was a new legislation amendment introduced on the 1st of April last year, Section 18, capital D, and that, with all respect, was not properly drafted. There were a lot of issues as far as that particular section is concerned. There were already certain amendments made in that regard, but certain uncertainties remained, and hopefully that they have now recognized that there are problems with that section and that they will hopefully clear that up. Gold exports in respect of where the gold mines deliver gold to a refinery, that gold-containing material is generally co-mixed or commingled with other gold mining companies' products that are provided for refining. That caused certain problems with regard to the documentation on the exportation of the gold eventually, because the product that goes into the refinery is commingled and the product that comes out is totally different from the product that went in. And that caused certain problems with regard to the documentation. That was also ruled upon in terms of a Section 72 directive from SARS, and it seems that that directive will also now be legislated for. Then, as far as the domestic reverse charge is concerned, we've seen the regulation being introduced last year with effect from the 1st of July, but effective for all transactions from the 1st of August. In respect of the curbing of certain fraudulent transactions in the gold chain where it is provided through to refineries and then eventually sold, there were certain issues with regard to the interpretation of the regulations, and I'm not going to go through all of them, but quite a number of these issues will be dealt with, it seems, in amendments to the regulation drafting. In particular, there's a definition of residual goods as to what that entails. Will it only relate to mining residuals, or will it also relate to or extend to the normal meaning of the word? Then the definition of valuable metal will be clarified. The exemptions from the valuable metal, particularly the holders of mining rights and the contractors to holders of mining rights, those transactions between those entities will hopefully also be clarified so that we have certainty as to what is excluded from these regulations. They've also realized that there are certain consequential consequences as far as the regulations are concerned. For example, they will now introduce, it seems, a de minimis rule that where you provide gold with a minimum content, they didn't say what that minimum content will be, for example, gold-plated jewelry, that those will be excluded from the regulations as well. And that is to be welcomed, because at the moment, if there's any content of gold included in the product, it falls within the definition of valuable metal, and it is covered, or the regulations then apply. There are also certain clarifications with regard to the obligations of the recipient, where the recipient cannot issue a statement as is currently required to stipulate what the gold content of the product is that they've purchased. That obligation will now shift to the supplier. So that is as far as the VAT proposals in the budget is concerned. If we then just turn to the next slide, please. If we turn to the run-up to the budget, in every budget, and it's no different this year, there's always some recommendation and requests and submissions as to what should be included in a budget and what should not be included, and certain recommendations as far as that is concerned. And this year, the loudest voices that we have heard is from the poultry producers, where they recommended and requested and motivated that chicken should be excluded, or rather included in a list of zero-rated items in order for the chicken pieces, the bone chicken, to be zero-rated for VAT purposes. And they've motivated that on a basis that in South Africa, the largest portion or items of meat and that is consumed in a country is actually chicken. That is compared to beef and lamb and pork. And it is also a large source of protein for low-income and poor households. And on that basis, they requested and motivated that it should be included in a list of zero-rated food items, which does not contain any meat items at this point. And they've expanded the request on the basis that it would also assist the farmers, which are struggling at the moment with increased chicken feed prices and also load shedding, where they need to keep their generators running. And as far as they are concerned, the increased demand that the zero rating will create will also then assist the farmers as well. The question really is, although it is a well-motivated request and submission that has been made, the question here is whether one should use the VAT system in order to achieve certain socio-economic goals or objectives. And there are a number of concerns that we have with regard to the use of the VAT system in this regard for introducing zero rating, whether it's chicken or whether it's the solar panels or any other product for VAT purposes. The first aspect is that an ideal VAT system is a broad-based system in terms of which you tax as much as possible under the VAT system with as little as possible exception and exclusions and zero rating. And that allows you to keep the rate as low as possible. When you introduce more exceptions and zero ratings and exemptions, then it complicates the system. It makes it more difficult to administer from a SARS perspective as well as from a taxpayer's perspective. But also then it means that you narrow the base. And if you narrow the base, you come to a point that you have to increase the VAT rate in order to make up the revenue that is lost through the zero rating. A further aspect is that it is not always the situation, and history has shown that the benefit of zero rating is passed on to the consumer. We've seen that in South Africa and we've seen that in other countries as well. Consumers get used to paying a particular price for a product, and the suppliers then become very tempting to retain the prices at the current level and then just simply pocketing an additional 15% profit on the prices that are retained at the current levels. And a typical example here is in the UK, where in 2018 they zero-rated electronic books. And that was following a lobbying process by publishers in that country. And a current study has shown that the prices of electronic books in that country is basically at the same levels at what they were prior to the introduction of the zero rating. And the £200 million that costs the taxpayer to zero-rate electronic books has basically landed up in the pockets of the publishers. So also under a VAT system where you have additional zero rating, everyone benefits from that product that is zero rated. It's not only the poor or the low-income households. Everyone that uses or consumes that product benefits from the zero rating. And in this regard, the Davis Tax Committee at the time had a study done for them which indicated that certain products that are currently zero rated, in particularly milk, vegetables and fruit, that higher income households benefit substantially more from the zero rating of these products. And it's basically because they spend a lot more money in respect of those products. There are certain products that benefit the poor proportionately more, and that is particularly maize meal. But the point is that everyone benefits from a zero rating, and it's not only a particular targeted group as to why you want to zero rate. And then lastly, affordability is a big issue. If you can't afford, or if a person can't afford to pay 60 Rand a kilogram for a particular product, then the question is, but will that person be able to afford paying 52 Rand a kilogram for that same product on the assumption that the benefit of the zero rating is then passed on to that person? To put it in perspective, I can't afford to purchase a Lamborghini, but if they zero rated today, I would still not be able to afford that, even if the price is reduced by 15%. So the affordability is something that one needs to consider as well. So the question is then, but what is the solution to this problem if you can't use the VAT system? And in this regard, the Davis Tax Committee recommended at the time that what is required is a specifically targeted social expenditure program. So we then tax all the products at the standard rate, and you take the money that is collected from those taxes, and then you purchase the product, and then you distribute it to the people and the communities where it's really needed. But of course, it sounds quite simple, but in the South African context, we do have the problem that you still don't know whether that benefit will end up with the people that actually need it, because the benefit may likely end up in the hands of the people who are tasked with the distribution. But in any event, in summary, therefore, we have a situation where there is a need for social economic relief. The point is that one should be careful not to use the VAT system in order to achieve that. There are other ways and means, better ways and means of doing that. Right, then just lastly, what I just want to briefly discuss with you and just give you some insights into VAT litigation in a South African context at this point in time. What I have done is to make a list of all the Supreme Court of Appeal judgments that deal with VAT technical matters and also VAT policy issues and interpretational issues over the last 6 years. It's probably from about October 2016 until now, so it's just over 6 years. And also the High Court judgments that dealt with these VAT technical issues. And I've excluded the VAT or the High Court judgments which landed up in the Supreme Court of Appeal anyway. So over this period, there were 12 Supreme Court of Appeal judgments and 4 in the High Court that dealt with these complicated interpretational VAT issues. And out of these 16 judgments, only 1 was handed down in favor of the taxpayer. So the question is now, is there a problem with regard to the interpretation and application of the VAT legislation by our taxpayers? And I think here we need to consider it in perspective as well. Our VAT system in South Africa is in principle the same as what is operated in Europe, in New Zealand, in Australia. Our VAT system is modeled on that of New Zealand. And in the European countries specifically, they have operated VAT systems now for between 40 and 70 years. And there's quite a lot of VAT precedents, VAT case law, guidances and principles that have been established and that are widely applied throughout all those countries. And in many of the cases, the Supreme Court of Appeal cases in particular, the taxpayer relied on those foreign precedents and the foreign case law. But the court just dismissed them either on the basis that they are not applicable in South Africa or in a South African context. And in other cases, they specifically handed down a judgment which is directly in contrast with those long-standing policies and principles and precedents that are applied throughout all the other countries. So the moral of this story is that when you get involved in VAT litigation, the odds are seriously stacked in favor of SARS. So one just needs to keep that in mind. That brings me then to the end of the VAT presentation. Are there any questions with regard to what is in the budget or what is not in the budget, or what we've discussed now? Nothing? Thank you, Emil. Then over to you.
Thank you, Gerard. Just for those of you that don't know, Gerard was recently awarded the highest accolade possible in South Africa by Chambers Global from a VAT perspective. So congrats, Gerard. He's truly the foremost and the number one VAT expert in South Africa, and we're really glad to have him at CDH. Thank you. Just maybe to latch on to what Gerard said, and before that, if you look at the speculation beforehand, we don't have a wealth tax, we don't have an increase in the tax rates. Why not? And we have to thank for that. And the answer is really SARS. If SARS didn't overcollect, then they would have had to look for the revenues somewhere else. So, yes, in our dealings with SARS and how difficult they are, I think we should give that recognition to them, at least that they overcollected. And as a result of that, to a large extent, we don't have bracket creep or the increase in the rates and all those type of things. And yes, I think that's just one factor to take into account. But maybe to latch on to what Gerard said, yes, we've got rulings. These are now the numbers. Generally, I actually refer to in these type of talks to the taxpayers and how small the tax base really is and how many people have immigrated. But I thought not to bore you with that because you won't sleep tonight, because that pool is dwindling by the day to a large extent. But yes, let's look at a bit different and to latch on to what Gerard has said. 268 binding rulings, and I think that's probably the best section and department within SARS right now. They're responsive. They listen to your arguments, even though you don't agree with them necessarily. 620 non-binding opinions. I'm not really in favor of non-binding opinions because they're not binding. That's really what it says. So I wouldn't really go for those, but there's a number of them that have been issued. And yes, I think the big problem is if a transaction has been entered into, you cannot get a ruling. The only answer is then to get a non-binding opinion, because rulings can only be given on prospective transactions as such. But then to the litigation. A 31% increase in objections and a 26% increase in appeals. That's really the problem that one is facing with it now, and I think that's the one concern that we have, in the sense that whenever you submit your return, there's a small deduction that you claimed or annuity that you claimed or something that's not recognized, and it takes you 3 years to deal with that. And that's really, I think, to a large extent the problem, because there is no real mechanism to deal with something quickly. If it's just a simple error, yes, we have Section 93 of the Tax Administration Act, but that's, I actually don't know of any of those applications that have really been considered favorably by SARS, unless it's a clear error and just a calculation error, and you can show that, because the moment you raise that, they say, okay, let's look at the background and what's the reason for that, and did you claim allowances, let's audit the allowances, all those type of things, and then you're stuck into that issue, and you can't object and appeal against that. So yes, 126,000 objections that were filed and finalized. And that's the concerning aspect in 57% that were allowed and 19% being disallowed. So it's a lot of those type of matters that should not be assessed in the first instance if you look at the objections being allowed and not. Appeals. 8,500 appeals that were finalized against an inflow of 8,200. So they finalized more appeals than they received because there was a backlog. ADR, and that's at least, I think, what one should definitely do. 8,200 of the 8,500 that ended up in ADR to the tax board, 167, and then appeals in the tax court litigation, 167. So it's a very small number of these matters that actually go to court, and mostly are settled. And whenever you appeal, yes, tick the ADR box, you've got nothing to lose. Sometimes you walk out after 5 minutes, but sometimes you actually do settle the matter. And as Gerard has shown, and as you see from these numbers, it's not worth your while to go to court. Because, yes, alternative dispute resolutions, 8,200, of which 97% were resolved. 64% that were conceded by SARS. The taxpayer withdrew 1,700, and then settlements 436, which are, in any event, is better than losing in court. Tax court, 23% were settled. Taxpayers withdrew their appeal on 34%, and SARS conceded 26%. But that's the end of the losing streak on the part of SARS. 76% success rate on the part of SARS on the lower courts, the tax court. But then SCA, Constitutional Court, thank you very much. All of those cases have been won by SARS. That's the year before, and then last year there was actually just one, once again, case that was won by a taxpayer. So it's, if you know that you're going to court, yes, in the tax court there may be some chance, about 30%, thereafter zero, next to zero. That's the practical issue in tax litigation that one is facing with right now, especially if it gets to technical issues. A GAR issue, a highly technical transaction that you entered into. If you entered into, and that's one of the flavors of the day nowadays, a sale, a repurchase agreement, and a subscription agreement, the poor judge that's sitting there earning 1 million, 2 million rand, and if you've entered into a transaction for 2-3 billion rand, the natural reaction would be, no, somebody's saving money here, let's tax it. That's unfortunately the result that one sees in the court, the practical issues. Whether or not you may have merits, and we'll get to the coronation judgment a bit later, and I'd like to get your views on that, and whether or not that was correctly decided, and whether the Constitutional Court will hear that. But yes, I think to a large extent one should appreciate that there are concerns in taking a matter to court, especially to the extent that you appeal to the SCA and or the Constitutional Court. Your big G cases, all those type of cases that were held in favor of SARS. What are the issues that are not dealt with in the budget? Because those are obviously the type of issues that we'd like to have seen and which are not dealt with at this stage. And the first one is unlisted REITs. Because if you're a property company and you're not listed, you can never compete with the REIT. Because why? A REIT can deduct the distributions. 2, it doesn't pay capital gains tax. Yes, there's been some progress. Unfortunately, the regulator still needs to decide whether it goes ahead. There's been some draft provisions and regulations and all those type of things at this stage. I don't necessarily expect to see much this year, but there's been some progress. There's some progress. It's not a question that it's off the table. It's just a question of the FSCA committing itself to this specific issue. But yes, the moment you are a property company or developer, you just can't compete otherwise. Collective investment schemes, it's been an ongoing issue, and everybody is waiting with bated breath with reference to whether or not that's something, because most of the collective investment schemes, CISs, do dispose of their assets on a frequent basis, either to balance their portfolio because of the change in the volatile economy and all those type of things. And the question arises, to what extent is that on revenue account? Because we have a 3-year rule generally, but they never hold their shares or their equities on a 3-year basis. Yes, the 2018 amendments, and that was really that the one-year rule will apply, have not been implemented. There's been some discussions and a number of submissions that have been made, and we're waiting that discussion paper. I don't think, if you look at what happened now and see what happened with the coronation matter, is going to be that positive, but at least let's see what the outcome of that is going to be. Retirement funds two-pot system, yes, at least they postponed it because the bottom line is the industry was not ready. The systems are not there to cater for a third, basically, or a fourth system, because you've got the two-pot system, but essentially you've got the saving and then the previous systems and so on, and the industry was just not available and capable to implement it. Yes, now they say that it's postponed to 24 for the 4 reasons, being a proposal for seed capital, legislative mechanisms to include defined benefit funds in an equitable manner, legacy retirement annuity funds, and withdrawals from the retirement portion if one is retrenched and has no alternative source of income. I think the real bottom line is the systems that need to be aligned for this type of system, because yes, a two-pot system, saving pot, you can withdraw it, but yes, you're liable to income tax rates. If you leave that pot until retirement, then you're taxed as if it's a normal retirement withdrawal. So that's really the bottom line associated with the two-pot system. Yes, you benefit if you're retrenched or something to that effect. You have access to that. Yes, you pay income tax at the marginal rate, but at least you have access to that, and the balance, your savings pot, is available. Your retirement pot is there for your retirement, and yes, depending on your circumstances, if you keep it there, you're going to be taxed as if you retire normally. So that's the benefit of that. Home study allowances, I think we can write that off. There's not going to be legislation associated with that as opposed to the solar. You saw the interpretation note basically confirming the approach of SARS, and it's going to be very difficult. Everybody that I know that tried to claim a study allowance has been audited. So if you do that, be aware of that fact. It's very difficult to get that allowance successfully, and it's audited, and you have to get all your documentary proof in order, because otherwise I don't think it's much going to be happening in relation to that. Vision 2024, yes, another year, but I think we're going to see substantial change with the increase in the tax system and the software of SARS, because yes, they get it from the banks, the information, all those type of things. You see that population, people that don't need to necessarily complete their income tax returns with reference to interest received, those type of things. And mostly, yes, they are correct. I think if they're provided by the South African banks, if they're provided by smaller players, you've got problems. And to object against that is also a mission, because that's really the information that's received by SARS from the third party concerned, and to change that is basically impossible unless you go to that third party service provider and they actually change their submission to SARS, and that's really the only way as opposed to SARS changing that, because they just say that's the information that they received. The one thing, however, that we can expect is also a change to the provisional tax system, because currently we pay tax on a 6-monthly basis, and I think well, at one stage, they actually indicated that one should pay tax on a monthly basis. It may be quarterly, who knows, but that's really part of this process. And the interaction of taxpayers, in the sense that to the extent that the information is provided by banks and third parties, they know what the amounts are, so you can actually pay your provisional tax from that perspective. And that's really the argument from SARS. They're losing out from the time value of money, because you receive your money now and you only pay your tax 6 months later. And that's really the argument. Pillar 2, for those international clients, not that many in South Africa, but to the extent that the group revenue exceeds 750 million euros, you're going to pay effective tax at least 15%, so your tax haven, Cayman Islands, Isle of Man, those type of things, you have to take that into account. But the one benefit is that South Africa at least decided they're going to wait with the implementation of that legislation. Because what has been the problem with South Africa and the OECD The problem really has been South Africa has been on the forefront of all these amendments. Whenever there's BEPS, whatever's, and we saw that over the years, South Africa just introduced the legislation to the nth degree. Whereas other countries, even developed countries, Europe and America, Canada, those type of things, waited. 1, they didn't implement all the proposals. 3, whenever they implemented their proposals, they were not so severe. But South Africa implemented everything. Our CFC system is, for instance, the worst, one of the worst in the world, if you compare that to other countries. Those the 23M, I'm just not sure how you're going to implement that right now if you look at the way it's being worded and if anybody really understands all those amendments, even though amendments are going to be introduced even now. So that is really, at least there's now some appreciation. Let's wait. Let's see what the other countries are doing. Will the USA, in fact, implement these type of things? Because, yes, they may say so, but we need to see. And that's really one of the things that at least there's some recognition that we have to wait before we implement these type of issues. So we're only going to see that in the next year. I'm going to spend some time on 2 critical matters. And then we can deal with some of the ancillary issues. And the one is the withdrawal or the potential withdrawal of Practice Note 31. Yes, it is going to be withdrawn. The question is just what is going to be in its place? What are they going to introduce in its place? Because Practice Note 31, 30 years, 2 small paragraphs, but a significant impact upon taxpayers and whenever you have an interest burden or liability. Yes, the first paragraph, if I borrow at 5% and I unlend at 6%, it's clear you're actually going to make a profit. It's a venture that you're entering into. You can deduct at 5% interest. That's the first paragraph. And even from a case perspective, there were 1 or 2 cases that indicated in those type of circumstances, there's a clear link between your borrowing and the lending. I borrow at 5, I lend at 6% to my subsidiary. There's a clear profit there. And that's why you need to make the profit as opposed to just lending out at 5%, because the moment you lend out at 5% without the practice note, there's an issue whether or not you are trading. Because trade to a large extent implies a profit. And if you don't make the profit, the question is, why don't you make the profit? Is there another reason as part of your trade, like the loss leaders, for instance, in Pick n Pay? If you look at the newspapers, they advertise, yes, you can buy Coke for R1, but they want you to go to the shop because they want you to buy other things. So it's a loss leader. Yes, you buy the Coke, but in the meantime, you buy soap and whatever the case may be in your groceries. That's why they have that type of system, and it works. But if you don't make the profit in itself from the 5%, that is the issue from that perspective. Second paragraph, SARS will allow the reduction of interest up to interest received, even though there might be a link between the 2 items. So at this stage, you can have one line item, R100 interest received, another line item, R100 interest incurred, and SARS will to a large extent allow you that deduction, whether or not there may be a link between the 2. Originally, the second paragraph was sought to deal with a scenario where you actually borrow at 5% and then on-lend at 4%. So you actually lend out at a loss. But over the years, it's been interpreted such that there doesn't necessarily need to be that link between the 2. So as long as you've got interest paid, interest received, that's it, and you can actually deduct it too. And that resulted in a number of taxpayers now entering into transactions where they borrow money, they use the money for non-productive purposes, let's say to buy shares, and on the other hand, they receive interest and they say, okay, let's deduct it. And that is really the concern of SARS, because there's no link between the 2. And on any event, you're not entering into a trade. A trade is a profit. There's not a profit, but at least they were comfortable with that principle. The issue that they have a concern with is to the extent that there's no link between the 2. Let's say a holding company borrows R100, interest-free to one company, 5% to another company, those type of things. Can you justify that? Because, yes, even though you actually borrow at 5%, why do you on-lend at 0% to your one subsidiary and, let's say, at 5% to another subsidiary, or to 6% to another subsidiary? Can you justify that, or do you say, yes, it's treasury operations, my treasury operations themselves ultimately are intended to make a profit, and ultimately I can show on an aggregated basis, I actually paid 10 Rand of interest and I received 12 Rand of interest. That type of argument. Because that may be the case in the case of treasury operations, but if you just borrow and on an isolated basis lend out to 1, 2, 3 subsidiaries, and the one subsidiary is 0%, and the other one is at 6%, and so on, then you're going to have a problem without the practice note. The other issue really is that the practice note is at this stage based on an incorrect assumption, because it refers to a money lender. But money lending is not the test to determine whether you can deduct interest. Money lending is a test to determine whether or not you can claim a loss if the debt is not repaid, like the solar glass case that we all know about. The case and the test in the case of borrowing and lending is there a trade? And that trade in itself can be an isolated venture. Burgess case, and in that case then the issue is, do I borrow with a view to make a profit, or expect it to make a profit at least from that perspective. So it's not money lending, that's a test, and at this stage unfortunately the indication is, at least from the practice note, that money lending is a test as opposed to a trade that is the test from that perspective. Treasury operations, yes, I think theoretically you can maybe justify that if you want to say, yes, generally I borrowed and I paid 10 Rand and I received 12 Rand, but you must still be careful, like the Standard Bank case, you borrow generally upon a large scale with a view to unlend, that type of test. And then you must have true treasury operations in your group, as opposed to borrowing now and then and lending now and then to your subsidiaries and so on. True treasury operations, where all the subsidiaries also deposit their monies back to the treasury company and so on. That's a different issue. But yes, I think to the extent that they just withdraw the practice note, lending of monies just by a holding company is going to be very problematical. And we have to see lots of submissions have been made, probably the most in relation to this last year, because the impact is substantial and the monies involved are substantial from that perspective. Venture capital companies. Who wants venture capital companies? VCCs are dead. Long live solar panels. If you think that there was potential abuse on VCCs, you're going to see the abuse now on these energy projects. If you can claim 125% on an unlimited basis, and that's really, and I can guarantee you, you're going to see the first funds tomorrow. There's this one song, heaven is a place on earth. I would say in South Africa right now, if you invest in solar from a business perspective, you'll get to that. But yes, currently you've got the 100% allowance should you buy plant, use for the first time, etc., in respect of solar energy not exceeding 1 megawatt. So at this stage, you have the distinction between 1 megawatt and not. If it's less than that, 100% allowance. Otherwise, it's 50, 30, 20. For business purposes. And then you had the ruling, the first step in the process, ruling 85, the issue. I'm not going to do like all these actresses and so on, where they say, let's stop the process. Are you all right, sir? Not yet. You look okay. The ruling. Partnership, because why do you want a partnership? Because the partnership is deemed to be trading in terms of 24H. Those of you that are old enough, the movie schemes, the livestock schemes, all those type of things, that's really the principle that was established pursuant to the partnership. Because if the partnership is trading, you as a partner are trading. Okay. Now, the partnership outsources the operations to the applicant. Profits made of the generation of assets will be paid to the limited partners in accordance with their ratio. The one thing that the ruling does not clearly indicate, and you should be careful to the extent that you invest in what we call an income on deed or a limited partnership, because in that case, your allowance is actually limited and your expenses are limited to the extent of your exposure to the partnership, your contribution or your exposure to third parties. Don't think that you can just deduct all the expenses of the partnership. So there is a limitation to the extent that you enter into what we call a limited partnership. Yes, a limited partnership has the benefit that your expenses and your liabilities towards third parties are limited, but the consequence, you can't also not claim the deduction from that perspective. So there's a benefit in making use of the partnerships or not. And the thing here is what they're going to do, it's one big partnership, the head partnership, and then you've got sub-partnerships on top of it, and they're going to invest in the big partnership, and the big partnership is going to invest in the plant and so on. And you've seen that, they're advertising that principle. And the big thing there is the generation assets, not limited only to the solar panels, the batteries, everything else, cabling, foundations. So you could claim the allowance, and there was always this doubt whether or not you can claim the allowance on the inverters, the cost of installation, on all those type of things. Yes, that's the ruling. The downside, what was the downside? The fees. 1% upfront, 2% annual, and then to the extent that you receive back your capital that you contributed, 20%. So that's quite high, and I think there may well be other funds and so on that will come off the ground. The other funds really make use of a company structure where the company then claims the allowances and you receive the dividend. What is the downside of making use of a company? Similar to what we're going to see now with reference to these other companies that are going to invest in these type of renewable energy projects. Section 20. Yes, you can claim your allowance in year 1, 125% and so on, but you won't have the income to set it off against. Year 2, what's going to happen? 80%, 20% rule kicks in. You can only use your assessed loss up to 80%. And you're going to pay tax on your 20%. So don't think that you're not going to pay tax as such. That 80%, 20% rule on assessed losses is going to catch you to the extent that you make use of the company process. Yes, businesses, if it's for trade, 125% deduction in the first year for all renewable energy projects, not limited to solar, with no thresholds. VCC, your limits of the 2.5 million to hold it for 5 years, the type of investments that you could make, the connected person issues, all those type of things are gone. So why don't we all invest in this now? Just to get the allowance. Because yes, at some stage people will invest in this type of project just to get the allowance as opposed to whether or not this project is going to make a profit. And the big thing that we're going to see is you've got all these funds and the funds won't have projects to invest in. And that's really the type of issue that one is going to see. And SARS is going to say, yes, you've got the fund. Are you in fact trading because there's no projects that you have? And there may be some solar panels, but you can't sell it because, yes, you can only sell it to Eskom, but not to whoever else and whatever the case may be. So that's the type of issue that you're going to see. In the video, and it must be brought into use for the first time between 1 March 2023, just now, and 28 February 2025. Individuals, just in respect of your solar panels. 25% of the cost of any new, not used, new and unused solar panels and installed to private residents, it must be your own house, not somebody else, between 1 March 2023, 29 February 2024. But what's the catch? Limited to 15,000. So if you want to, you must pay it separately and whatever the case may be, because to a large extent, it's basically a percentage that's determined, and that's 25% of the cost. So the moment it's more than 80,000 rand, you've got a problem because you won't be able to claim it. Up to the 80,000 rand, you can maybe, or 60,000 rand, you can claim that. Solar panels with a minimum capacity of 275, that was not necessarily mentioned in the budget speech as well. Must have a VAT invoice and a certificate of compliance, that's really the test. No incentive for diesel generators. Why? Because this is in green energy, but at least we have that benefit in respect of producers of food that now can claim the diesel refund. So that's a big thing, I think, from that perspective, that the diesel refund is going to be extended, at least for the producers of food. Landlords, all lessees can claim it. It's really the party that pays for it that's going to be able to claim the allowance. No recoupment if you sell the house, because the argument is at least somebody else will use it then as well. But if you just sell the panels, then it's going to be recoupment within 1 year. So that's more or less the thing. Yes, you can claim your 15,000, and I'm really sorry for you that couldn't wait. I waited. You can't sell it and repurchase it now again. You can't enter into a resale agreement because you can't claim the allowance in respect of that. So if you must maybe speak to your supplier to re-invoice you after 1 March from that perspective. But yes, I think we definitely need that. I'm told that somewhere in the East, that's really, I think it was Philippines or one of those countries, they had a similar type of problem, and they actually solved their problem on this basis because they provided the incentives, and people could then send their energy back into the grid to the extent that they didn't use that. And after that, after 6 years, there were no problems anymore. So at least I think we're on the right track from that perspective. Those were the 2 big things. I'm not sure whether there's any questions in relation to practice note 31 or the solar panels. Yes. Yes, yes. You can't claim the cost of that. Only actually the cost of the solar panel. You must be careful there, because you can't claim the cost of all these associated costs. Okay, let's maybe look at the. Sorry, there we are.
Yes, there's a question from the chat, and they want to know on the renting of solar panels. Will the allowance extend?
If you're a business, yes, you can claim that. But to the extent that it's on your domestic, you can't, because it must be for your private residence. So yes, the answer is no there. But you can't structure it such that if you rent it out or let it out, then it's a trade potentially. And on that basis, be able to claim that. Let's look at some ancillary issues, because I think there's a few things very close to my heart, which I lobbied for at SARS. But let's look firstly at the coronation case. And I think there's a lot of people that are very concerned right now, and there were a lot of people that were very concerned after the coronation judgment. Because essentially, coronation, those of you that don't know the judgment, fund manager established offshore. The issue really to a large extent was that they performed their administration self, but they outsourced, potentially, call it, and that's really the debate right now, the primary function being the asset management function to a third party. And the question was really from an FBE, foreign business establishment perspective, whether or not you can say there's a foreign business establishment in those circumstances. Now, if you look at the case, and yes, there's, I think you saw the announcement by Coronation that they're going to take this matter to the Constitutional Court. Personally, I don't think the Constitutional Court will hear this after the announcement to amend the legislation. But let's see, because it's got a significant impact upon the fund managers themselves, not so much on the investors. So I think that's really, if they can persuade the Constitutional Court it's got an impact upon the investors, yes, because then it's a public interest issue. But if it's just for the asset manager itself, then that may be more of an issue. But I think the reason to a large extent why Coronation lost is because of the MOI and their ancillary documents. Because those documents actually said, yes, you can enter into fund management. And then the SCA then latched onto that and said, okay, if that's the case, why did you outsource that? Because that is your primary function. You should not have done that, and you don't have a foreign business establishment. So I think from a technical perspective, it's more on a wording issue. That they lost, and the reason for that why they lost, as opposed to, let's say, a scenario where the MOI was foolproof in a sense that they clearly didn't have the license to conduct asset management activities. They could have done so, even though they didn't get that additional license and all those type of things, and that's really what the court was concerned about. But after the Coronation judgment, the issue is really, can you outsource your primary activities? And I think that was the question that wasn't really answered by the court as such. And now we have this. because a foreign business establishment is defined as a fixed place of business that is used or will continue to be used for the business of the CSC for at least 1 year. It must be suitably staffed with on-site managerial and operational employees, must be suitably equipped and have suitable facilities. You must have your office, your table, your kettle, your secretary, whatever the case may be, and they must work there, as opposed to a professional person that's not necessarily competent to deal with your business operations, because often you see these professional directors that are actually appointed in the circumstances. Now, and I think that's where the problem comes in. New tax legislation that to qualify as this FPE, all important functions for which the FSC is compensated needs to be performed by the CFC or by another company in the same country and forming part of the same group of companies. So yes, that exemption is still there if you do that, or you may have your high tax exemption to the extent depending on where you are, but to the extent you've got your primary activities and you give yourself else as an asset manager or a lender of monies and that type of things, you can't say, yes, I outsource my lending activities to somebody else, your treasury operations to somebody else. You must conduct it yourself, and that's where the legislation comes in. I think it's going to be a huge outcry. Probably if you're going to look at the newspapers tomorrow, that's going to be some of the headlines probably. Although some people missed it originally, but later on, as and when people read all the documents and so on, this is really one of the major issues in relation to the tax proposals that were done. And it's not limited necessarily to asset management. It's any other company that got the distribution functions, let's say, offshore. You can't outsource your distribution function. You must conduct your distribution function itself. It's those type of things, because on that basis, you're going to fall foul of this provision. So it's a massive issue, I think, especially in those type of industries where you outsource, because the counter argument is, I want to outsource to the best person, the BlackRocks of the world and those type of things. Now you can't. Now people's not going to invest in you because you don't have the best asset manager, and if everybody is going to be prejudiced. So that's the type of issue that you're going to look at right now. Unbundling transactions. The year before last, there was a substantial debate with National Treasury in relation to disqualified persons, because essentially if you unbundle to a disqualified person, that's essentially somebody that's exempt. You don't qualify, that's over 5% and held more than 5%. You don't qualify for the exemption from an unbundling perspective. So the company that unbundles the relevant shares must then pay tax. But the National Treasury said, no, it's fine. If you paid 100 Rand in tax, we're going to apportion that then to the base cost of the unbundling company and the unbundled companies. And then last year, I thought, no, okay, let's maybe go for a ruling because the wording of the legislation is not that clear. And lo and behold, SARS then issued a ruling to the effect that, no, you can only claim a proportion of that tax that you've paid, and you can only allocate that to the unbundled companies as opposed to the unbundling company. I contacted National Treasury, SARS, and said, this is one part of our discussion. How can you now interpret that? And the answer was really, this is what the legislation says. And that's really where we are. If you draft it that way, and then subsequently SARS has to interpret that, whatever the intention may be of the legislation, because the intention was clear, there were a number of discussions to that effect. And at least, I think it's now been given, it only says consideration. I hope that they will actually implement it, but consideration will be given whether it's appropriate to apportion the tax paid by the unbundling company between the unbundling company shares and unbundled company shares, and to situations where the unbundling company is not in the taxable position. Because I'm not sure whether you saw last year RMI unbundled, momentum and those type of things, and one asset was actually transferred at a loss. Then how do you implement these sections? Because you actually set off the loss against the profit, you don't pay tax, and then you still give credit to the shareholders because of the tax that you ostensibly had to pay. So that's also not correct, and I don't think that was ever the intention if you actually unbundle some of the shares at a loss. So I totally agree with that principle as well. And then, yes, at this stage, only the base cost of the unbundled shares would be increased. At least if you pay the tax, the entire tax is used to increase base cost somewhere along the line. But at least, on the other hand, if there's a loss, you can't say, I actually was supposed to pay tax, but now I set it off against my loss, and therefore there's no tax, which happened in that case. Third-party backed shares and investment in an operating company. Now, those financiers amongst you that invest in preference shares, we have this one section, Section 8EA, to the effect that third-party backed shares, if you invest in a company and you use the proceeds of the preference shares to invest in an operating company, then the dividends are exempt. And you can get security. That's to a large extent, you can get security in respect of the preference shares that are issued. What happened last year is then SARS now issued a ruling. To say in that ruling, what happened is that the taxpayer complied with all of the provisions on day one. So the bank, let's say, invested in a company, and that company invested into an operating company. So everybody complied, and the bank took the security, which it could because the proceeds were used to invest in an operating company. But then, lo and behold, after a certain period, they had to sell the shares in the operating company, and the question arose whether the qualifying purpose still existed and whether the dividends are still exempt. And the ruling actually said, yes, no, it's still exempt because it's a day one test. The qualifying purpose must be tested on day one. But now SARS has said, no, the National Treasury has said, no, maybe not. It's not so easy. Legislation will now be introduced to make it clear that the dividend will not be exempt to the extent that the shares in the operating company are no longer held by the person who initially acquired them. So those lenders and the banks amongst you must be careful, because what happened then thereafter, which I saw one transaction, the people entered into a transaction on day one, let's say 100 Rand to invest in an operating company. They sold the shares on day two and then took the proceeds just to invest in other things. So the clear intention was always that they wanted to invest in other things, and they just complied with this provision so as to get the exemptions. So be careful of those type of things, because it seems that National Treasury picked up on that now. Non-resident beneficiaries of trust, those of you that for some reason are discretionary beneficiaries of foreign trusts or local trusts, or those people that have immigrated and still have local trusts here, because to a large extent the high net worths have still got local trust and they financially immigrated otherwise. This stage, paragraph 80, says that if the local trust vests the capital gains in the foreign beneficiary, the trust has to pay the capital gains tax. So you can't pass the benefit, and paragraph 80 of the H schedule doesn't apply such that you can now say, I vest the gain in the non-resident beneficiary and therefore there's no tax. So the trust in South Africa has to pay that capital gains tax. What they're going to do, because there was this argument that it should in any event apply to Section 25B on income, like interest and that type of thing. And there's been some argument to say, no, the same principle should maybe apply, and I think the legislation is now going to say no. In that case as well, whether or not it's income or capital gains, it's the trust in South Africa that pays the tax at the highest rate possible, 45%, and then you can vest it in a non-resident beneficiary. So it's going to have a huge impact upon that, because yes, the exchange control regulations were relaxed such that you can pay it out, but I think the issue now is that you're going to pay the tax if you want to do so. So beware of that from a practical perspective. Participation exemption, I've been looking the whole day for this provision. Silence on loop structures. The Reserve Bank doesn't necessarily approve loop structures. Everybody's guessing, is the Reserve Bank going to withdraw that now, or what's going to be the position? Because there's nothing coming out from that. But nothing was announced either today, which I could see from loop structures, because the rumors are that they may withdraw the loop structures. But what you can see now, a number of provisions have been inserted so as to address some loopholes potentially as a result of loops or similar type of structures where there were tax benefits. And the first one is really the participation exemption. Participation exemption really means that if you hold more than 10% of the shares in a foreign company, number one, your dividends that you receive will be exempt, in South Africa, and to the extent that you sell your shares in that foreign company, you are exempt in terms of paragraph 64B if you've held those shares for more than 18 months and you sold it to a non-resident. Now, similar type of 18-month rule will be introduced with reference to a reduction of CTC or your capital, because at this stage you don't have that 18-month rule, so that's the first thing that's going to be introduced. If you return capital from offshore, you must hold it for 18 months as such. Also, to the extent that you set up a similar structure. What has happened, people have this offshore company, and let's say I hold the shares in a South African company, which holds the shares in an offshore company. So what I do, I set up a trust offshore. I'm the beneficiary, or I set up the trust, and the trust buys the shares. So basically, it's the same type of people that own the shares in this foreign company afterwards, but the South African company gets the participation exemption because it sold shares to a non-resident. So what's going to happen now, introducing legislation to the effect that it's more or less within the same group of companies, which are not necessarily connected, or if it's more or less the same shareholders, then the participation exemption will not apply. So one should be careful of those parallel, we call it parallel structures from that perspective. Also loop structures. Listed company in South Africa, listed company, but the foreign company that's listed in South Africa, so it invests in South Africa in interest-bearing bonds. South Africa deducts the bonds, the dividends are paid, and the dividends are exempt. Those type of loop will now be covered in the sense that you're not going to get that exemption anymore to the extent that there is a deduction that's claimed in respect of whatever monies were invested in South Africa. So those type of things similar. If it flows in that case, then not deduction from that perspective. Also, the deduction in respect of a CSC context, the exemption of a foreign dividend no longer apply to the extent that it's currently taxed at 20%. So yes, if the amounts are deductible, similar type of thing, whereas currently 20% as opposed to 27%, because if you get your dividends, essentially, if you flow it through, the ultimate maximum tax is 20% in terms of your loop structures, but now it will be 27% if there was any deduction that was claimed in South Africa. So be aware of any loop type of related issue, because people argued, yes, at least you score or benefit to the extent of 7%, because the dividends tax or whatever was only 20%, whereas your deduction was claimed at 27%. So you had that arbitrage between the two type of transactions. And then lastly, there's always this issue in relation to non-resident employers. They don't have a representative person in South Africa. So they say, okay, we can't deduct PAYE, we can't deduct skills development levies. So what now? Our SARS going to collect a PAYE, and then going to introduce legislation to cover those type of things, because there's lots of foreign employers that employ people directly in South Africa, or foreigners working here, and the argument is that there's no representative employer, so therefore on that basis we don't need to deduct PAYE. Not only PAYE, but also the skills development levies and unemployment insurance contributions. So to a large extent that is then also catered for. Thank you very much. Those are the highlights from my perspective. There's a number of other technical issues like 23M and so on, which I'm not going to bore you with, because then you're all going to get to sleep. Any questions from that perspective, or anything that you'd like to raise?
Emil,
yes.
Can I ask a question? Those CFC rules, do they work in the reverse? I mean, what happens if I open a company here as a foreigner? You know what I mean?
Well, no, because it's not it's a different issue altogether. Because you tax in South Africa on whatever the company is in South Africa. So
you can't claim that I don't have people here and I outsource.
Well, no, that's the problem, unfortunately. Yes, we have the provision, and just maybe to take a step back, we have the provision in treaties and also the definition of a tax resident to the extent that the treaty overrides that. And the treaty basically says that most of the treaties actually say that if your place of effective management is somewhere else, then the place where you're going to pay tax is where your effective management is. So if your effective management is not in South Africa as such, then you're going to pay tax in South Africa, but you're still a branch potentially, so you have to impute profits to the extent of the branch operations. But there's just one residual issue, the MLI, multilateral instrument, which kicked in. To a large extent, the withholding tax is already in place, but the other provisions from the 30th June. And to a large extent, South Africa has then a choice whether or not to afford you the benefits in terms of the treaty. And if they think, no, there's something going on here, they're just going to say, sorry. And that's a provision that was always in the Mauritian Treaty to a large extent. And the number of taxpayers fell foul of that because South Africa just said, okay, if that's the case, you can argue whatever you want to argue. I'm not going to recognize you as a resident in Mauritius, and therefore on that basis you don't get the benefit of the treaty. Whatever requirements may have been from a Mauritian perspective. And I think it's a similar issue here. If they think there's a problem, they will just say, sorry, we're not going to afford you the benefits of the treaty and we're going to tax you here anyway. Whatever the case may be, even though you may fall outside that because your place of effective management is somewhere else. Because, yes, if you look at that in the reverse, it may be the case that your place of effective management may be somewhere else, but yeah. So that's a long answer to a short question. Yes?
Emil, can you please comment on the impact that the coronation case has on foreign properties which are managed by rental agents and not directly by the CFC?
There's also a long answer to that. Yes, I think it's definitely going to be a problem. 1, 2, in terms of the new legislation, it will be a worse problem. And then 3, in any event, there's been substantial submissions that have been made to National Treasury over the years, especially by REITs, because REITs actually purchase a property offshore, but the manager is in a different country, and they didn't qualify as a foreign business establishment because it's just a property, it's not the management, etc., etc. So at this stage, in any event, without the coronation case, you had a problem with reference to foreign property that was purchased and managed somewhere else. So those are, once again, the long answer to a short question. Anything else?
Just to go back to the renewable energy allowances, does a taxpayer choose whether to claim the allowance of 125% or the one in terms of Section 12B, so the 50, 30, 20?
Yeah, I think it will be substituted. So you're going to see a new 12B to a large extent. Okay. Thank you, everybody. Those of you that are online, we really appreciate it. As we've said, there's a number of alternatives and choices that you could make, and we appreciate that you made this choice. Obviously, always the best, but it's up to you to decide. And those of you that are here in person, hopefully next year, more people will be here. I was just, unfortunately, to a large extent, my doing that there's so few people here because I didn't want to be accused of a COVID spreader or anything like this. Even though last night we were at deal makers, and I think there were more than 1,000 people at the Sandton Convention Center, but I think it's maybe better safe to be sorry, a lot of safe as opposed to be sorry later on. So yes, but we really wanted to see some people at least again face to face. It makes a difference. We still recognize the faces. Nobody changed, so that's really good. And that's after 2 years. And then coming back to that first clip that we had, yes, we're definitely back in action, and thank you so much.
Visions are desires that flicker between a wish and intent. They are carvings waiting for the artisan's hand. One who is consumed by purpose. One who can bring vision to fruition. Cliff Decker Hofmeyer, incorporating Kieti law from vision